This video will cover productivity and growth. We'll point out that there's tremendous variation in the standards of living across countries, and the variation is determined by productivity per worker. We'll also show that labor productivity growth, which translates into real GDP growth for a country, is key to its long-run prospects. Take, for example, I have listed here country A and country B. Let's say 120 years ago, both countries started out with the same real GDP, $1,000, let's call it per capita. $1,000 per capita, per person, and country A grows at 3.5%. 3.5% for 120 years translates into real GDP, excluding inflation now because we're saying real, is $62,064. Take country B, for example, also. They have $1,000 in GDP 120 years ago, real GDP. They grow at only 2%. Now, that's only a 1.5% difference. They compound out for 120 years to $10,765. So it's about $62,000 to $11,000. That's a huge difference in GDP and the standard of living. And it's only associated with a 1.5% difference. Like, what accounts for that 1.5% difference, or can account for that 1.5% difference? That's what we're going to talk about when we talk about determinants of GDP. So the point is, differences in GDP growth over the long run has dramatic effects on people's well-being. Then we'll discuss how countries can go about promoting long-run growth, what kind of policies they can implement. And then at the end, we'll discuss the Congressional Budget Office's projections of long-run potential GDP. That'll become important because that's basically our long-run aggregate supply curve that we're going to look at in a later chapter. And it's an interesting benchmark in which to compare the economy to. So what I want to do now is I want to move over, look at some graphs. And the first graph we want to look at is real GDP. So this is real. We've taken out the effects of inflation, so that's out of the picture. And you can see that there's, some bumps and wiggles along the way. We've seen this before. The gray is recessions. And, by itself doesn't say a whole lot, but let's take the growth rate of that. So let's put it in percent changes. And now when we get it in percent changes, a couple of things. I put in this orange line here to show you that's ballpark where the average is. And so that's 2.5% average right there. And that basically accounts for this upward slope, 2.5% approximately, 2.5% over all those years. And so you can see that we go into booms, high growth, and then we drop off into negative growth often, or very low growth when we hit a recession. So often it peaks before a recession, right here, for example. The peaks are here, and then, right before or during a recession, it falls off. Okay, we know that already. But now I want to make another point here. We really want to, we often make comparisons here of real GDP, and we look at real GDP growth, but then we need to think about and sometimes discuss growth on a per capita basis, because if you go back to this graph here, one of the reasons for this graph going up is that the population in the United States has grown a lot since 1978. So when we get it on a per capita basis, we wring out those effects of population growth, because obviously your economy is going to grow as your population grows. Then what we want to do is, let's take a look at real GDP growth per worker now, not the population, but workers. If you look at the United States, only about 62%, low 60s% is called the labor force participation rate. So there's nearly 40% of the people in the U.S. are not working. And so we want to take that and look at it on a per labor basis. And sometimes our text is talking about output per worker. And this is output per worker growth over time, real growth. Then what we'll do at the end, we'll take a look, like I said, we'll look at real GDP versus potential GDP. And we'll look at the difference between real GDP minus its potential that's estimated by the Congressional Budget Office. And that's another measure of basically business cycle aspects that are going on in the economy. Now, it's important to recognize and realize that those wiggles around the zero mark there basically represent the business cycle, short-run deviations from a long run. That's really what's going on here. So potential GDP is the long run. And we often deviate for short periods of time from that long run, but the economy tends to snap back. And we'll talk about that further on, how the economy snaps back. In part, it automatically snaps back. It has automatic mechanisms through price adjustments to come back to that long-run potential. But there's also the U.S. government and the Federal Reserve trying to nudge the economy to get back to long-run potential faster. Because remember, John Maynard Keynes in the 1930s saw the horror of the Great Depression and said, we can do better. We can move the economy back to potential a lot faster. So it's important to realize that when we're above that line there, we're in the good part of a business cycle, positive end of things, what's going on there? Let me tell you what tends to happen. And we don't look at it too much in this course, but in my financial markets and institutions class, which is about banking and the Fed, we look at this very closely, these relationships that are going on over the business cycle. And when we're above the average, above potential there, the economy tends to lever up, meaning, and when I say the economy, but the banking system and people tend to borrow a lot of money on average. And so leverage ratios goes up. Leverage is how much debt you have relative to capital. And so your debt to capital, your equity tends to go up. People leverage up. Prices tend to go up. We tend to get asset bubbles. Stock market goes up. The real estate market tends to go up. We could get commodity price increases like oil going up. And at that time, there's basically feedback loops going on in the economy. So you have asset prices going up significantly, asset pricing bubbles. And then you got people using their assets, their real estate, for example, as collateral for loans. And so that's where the lending comes into play. So the lending is feeding on the asset bubble, and the asset bubble is feeding on the lending. People tend also to have low levels of risk aversion. So people are naturally risk adverse in general, but their degree of risk aversion falls off. It's almost like euphoria for a while. And then what happens in the economy, to pop the bubble, so to speak, either it pops the stock market bubble, or a real estate bubble, or some type of lending bubble where banks are lending too much money, and the bubble pops. It causes losses for banks. Individuals get nervous and scared. They start selling. And when they sell and they get rid of some of their assets they hold, prices drop. So the real estate, the asset bubble deflates. In fact, it deflates too much and it goes down too much. We end up going below potential GDP. Firms and companies and people deleverage. They want to get rid of as much risk as possible because they don't know if they're going to have the cash flow to pay off their debt when we go into a recession. So they're unloading debt. Prices are dropping. Commodity prices and asset prices are dropping, and even inflation, goods and services, is likely to have drops in those price levels. And so that's kind of what's going on in that business cycle: booms and busts, booms and busts. And as I've said before, if we can try to reduce those big booms and busts, we'd be a lot better off. Moving right along, let's look at the determinants of productivity. Now, I've got a list here of determinants, and what's interesting is not only do these determinants explain differences between countries' level of productivity and their growth rates in productivity, but it can even explain differences in the productivity and growth rates between states in the United States. So that's an interesting area. Obviously, the differences in states are not as dramatic as Bangladesh and France, for example, those differences. But nevertheless, there are significant differences from state to state that likely have impacts on productivity. It's an interesting area. One area that, for example, is education levels. Now, education levels vary dramatically from country to country, but they also vary from state to state. And education attainment levels are often a proxy for what's called human capital. And even sometimes experience is a proxy for human capital, meaning how much wherewithal you have bringing to the table for working a business. There's also health and nutritional levels that vary mainly from country to country, and I've done research in this area, and it even varies state by state, and it does have an impact on productivity state to state, but it's even more dramatic from country to country, so you need to have a healthy workforce, and nutrition is an important element of that. There's also technology, which obviously you think of as computers and network systems and things like that. But even as we mentioned earlier in the course, even how you arrange your kitchen or your farm, floor plan, for example, your floor space, your warehouse, even that is broadly defined as technology. There's also physical capital per worker, which, by the way, could have embedded in it deep technology that makes it very simple for people who are not that sophisticated to run equipment. And keep in mind that physical capital per worker runs up against diminishing marginal product of capital. So as you increase capital per worker, you get less and less output. And that's basically a production function ramping up. Production being on y-axis, and the x-axis would have capital per worker. Let me give you a historical perspective on the physical capital per worker concept here, and it'll help put it in better context, at least in this slide. A long time ago, it was thought that the differences in productivity levels and growth were mainly driven by the amount of physical capital per worker. That was the thought back then. That was the idea, that it was the reason. And then Robert Solw and T.W. Swan developed a productivity model. It's the workhorse of productivity in economics to this day. In fact, the Congressional Budget Office, when they developed an estimate of the potential GDP growth, it's based off the Solw model. And what that Solw model did was it brought to light the fact that, look, it's not differences in physical capital per worker that explains the differences in productivity and growth. It is something else involved. Hence, there was a gigantic shift in economics to try to find out and explain the different levels of productivity across the world in hopes to try to help those countries that aren't growing too well if we could learn more about it. And so what you see is this slide is a summary of the voluminous amount of research that's gone into this area. So while physical capital per worker obviously accounts for some of the differences in productivity, most of it's explained by the other items that we have listed here: education, health, technology, absence of corruption, infrastructure, and so on, as we'll get to in a few minutes. There's also natural resources per worker, which are important. And that's, for example, even miles of river that a country or a state has access to. It could be ports and oceanfront that countries have access to. Mountains could help or mountains could hinder economic activity. Desert and climate can have positive or negative impacts. So those are important. Then the flip side of things is the absence now. The absence of corruption is really important. So if you look at the book I have referenced here by Smoluk and Robinson, Why Nations Fail, it's an eye-opening book. And it talks about the countries that have high corruption or lack institutional infrastructure to manage an economy. They lack property rights, including taxes. So some politicians look at the tax system as a way to confiscate the wealth of individuals. And so property rights, including the effects of taxes, I think are important. And the motivation for strong property rights is fairly straightforward. People are not going to invest in a lot of time and money in various projects and products only to have it confiscated on them. So property rights are an important underlying feature of a strong economy. And then there's cultural aspects. So if you have a culture that respects these areas, you're more likely to have a more successful nation than a culture that doesn't respect economic activity. So these are just some of the areas. Like I said, this is a fascinating area. It's big and huge. I really don't give it justice. Neither does the textbook give justice to the determinants of productivity. Now, moving on. Saving and investment are very important to the Solw model. Recall I talked about the Solw model from the 1950s. It's still used today. That model had indicated that there was a golden rule level of capital stock per worker that would allow the economy to grow smoothly with roughly constant growth in output capital and labor. So that was the golden rule. Figure out the optimal savings rate so that savings and investment would lead to a constant growth in output capital and labor. The economy would run nice and smooth on that balanced growth path. To reach the optimal level of capital stock, it required just the right amount of investment per worker, and investment per worker comes from savings in the economy. But remember, in order to save, one must reduce consumption today in order to invest to raise productivity in the future, to get higher productivity growth. However, the optimal level of investment per period depends on the growth rate of the labor force, the depreciation rate of existing capital, physical capital depreciates, and the growth rate in technological progress, how much technology does a country have. Ultimately, as I said before, Solw discovered that different levels of productivity can't be due to physical capital differences. But he concluded instead, since it's not physical capital differences, he concluded that it's differences in technological progress. Different levels of technology from one country to the next explain the differences in productivity. And it's technological progress that depends heavily on education, but not completely, because technology and knowledge can be imported, and to some degree, knowledge is a public good. If that's not complicated enough, diminishing marginal product to capital needs to be taken into consideration. Different countries are on a different section of the marginal product of capital curve. Let me show you. Yeah, so it looks something like this. This is output per worker, Y. This is capital per worker, and that's what diminishing marginal product of capital looks like. So if you're a country with a small amount of capital per worker, you're on this end, the steeper end of the curve. Of course, you're going to get more gains as you increase your capital in this direction. You're going to get more gains in output per worker than if you're a country that has more capital. So you need to consider that, to take that into consideration. And if that's not complex enough, since the 1950s when Solw developed the model, economies have opened up to capital flows tremendously. So it's not just an individual country's savings rate that matters, it's the savings rates of the rest of the world and their investment levels in the rest of the world, because they have the ability to move vast sums of money into a country for investment. So I hope you can appreciate the complexities and the issues that are involved in trying to determine the differences in productivity levels across the world and even across the states. Let me tie up a loose end. I've been talking about savings and investment for a little while as equaling. Let me make sure we have a handle on that. So I'm going to assume a closed economy like Solw did in the 50s, because we basically did have a closed economy. There wasn't really much imports or exports or capital flowing back and forth. So if we start out with Y, which is output equals consumption plus investment plus government expenditures, you rearrange that, solve for investment. And that investment equals Y minus C minus G. Now Y, we know, is not only output, but it also equals income in this simple model, because we said that, look, whatever people produce ends up as being somebody's income somehow, some way. Therefore, the right-hand side of that is savings. Savings equals Y minus C minus G. And therefore, investments equals savings in a very simple model. That doesn't hold true, as I said, nowadays, because there's money that comes from abroad. It's vast money, sometimes called hot money, that comes into an economy so fast that it can really build an economy up, but it can leave even quicker if there's turmoil and political instability. that hot money can exit and leave a gigantic vacuum in the country. And there's one more complicating factor, and that is something underlying what I just showed you, and you may not realize it, but everything I showed you, let's just assume it happens on an annual basis. Okay? You have production for a year, you got income for a year, consumption for a year, and you have savings for a year. But not only that, but you have savings and investment. You got savings that piles up over the years. And it gets complicated by the fact that you notice we have this simple model, but it excludes, for example, a stock market or a housing market per se, like the actual value of housing. And what happens is our savings goes up because the stock market goes up. Our savings goes up because real estate values appreciate. That's really not captured fully in the model, so it gets a little more complex than what I'm even showing you. Even if the economy is closed, meaning it's not open to international flows of capital. Moving right along, let's look at potential GDP, full employment GDP, and long-run aggregate supply. Now, these three phrases are synonymous, but nevertheless, they have slightly different connotations, and that's what we want to hit on in the next couple of slides here. Let's examine all three descriptors, and in doing so, we'll better understand the concepts that we're working with. First off, notice that I have put in bold potential GDP first off for this particular slide, and it's helpful to look at how the Congressional Budget Office defines potential GDP. The CBO refers to potential as the maximum sustainable output level where the economy is using all its resources. The key here is sustainable, and it's maximum sustainable, meaning that it's not maximum. It's not just plain old maximum. Maximum could be, you have maximum GDP for a particular quarter and you can't sustain it. But this is sustainable long-run output, okay, where the economy uses all of its resources. And so, well, what do we mean by all its resources? That's generally defined as no involuntary unemployment. The flip side of that is full employment. Well, let's move to the next slide and talk about full employment GDP and unemployment. So sometimes it's helpful to look at unemployment when we're thinking about full employment, believe it or not. And so what we're talking about when we're looking at full employment is we're looking at very, very little unemployment, not necessarily zero unemployment. Let me elaborate and go through the slide. Okay, so the unemployment rate equals the natural rate of unemployment plus a cyclical component. We know what the cyclical component is. That's the business cycle. That's the wavy part, right? And so, set that aside and let's look at the natural rate. And the natural rate of unemployment equals frictional plus structural unemployment. Frictional unemployment always exists, and it's due to idiosyncratic job search. It's voluntary unemployment. People quit their jobs, they leave, they transfer, and it takes a while. It's called job search for employees to find employers and employers to find employees. Both sides are actually doing a search, and it takes a bit of time. So frictional unemployment is nothing unusual. It's a small percent that occurs all the time. The key is it's idiosyncratic. It's not associated with a particular industry or a region or phenomena. Okay, so now let's move on to the structural component, which is kind of what I'm referring to when I'm talking about regions or an industry type phenomena. So structural unemployment is due to, for example, creative and destructive forces. Examples of creative destructive forces are Uber wiping out the taxi business, or big box stores years back wiping out a lot of local small retail stores, and then online coming in and wreaking havoc with brick and mortar retail. Those are really big examples and obvious examples, but creative destruction is going on all around us, frequent. That causes what's called structural unemployment, unemployment that can last for a while. In other words, long-term implications. There's also mismatch in employer demand and employee skills, like I referred to above, but it's different. This is industry-wide or even regional. In regional, you can think of if there's a housing boom or a construction boom in one region, and there's not enough contractors and builders in that region. They're in another region that just finished up with a construction boom. So the mismatch of employer and demand and employee skills is one. Then minimum wage can also throw a wrench and cause structural unemployment. So if the minimum wage is set too high and it's actually a binding minimum, then that could cause unemployment and can cause unemployment for a while. Then there's the concept of sticky prices and wages, which we'll talk about much more later, and I'll also talk about in a few minutes. When I say later, I will talk more in a later chapter, but I'll talk about it shortly also in this video. So full employment is most consistent with just frictional unemployment. Full employment refers to an economy where there's no involuntary unemployment. Okay, let's move on now, and let's talk about sticky prices and wages and the long-run aggregate supply curve. So by now you know that when you see the phrase short run in economics, something is fixed. We saw that, for example, there was plant size with respect to manufacturing. It was the number of acres in a farm, or it could have been the number of firms were fixed in the short run when we looked at perfect competition, for example. And in this context, with the long-run aggregate supply curve, it's prices and wages that tend to be sticky. Prices, for example, don't tend to move as much as we would think when there's dramatic changes in supply and demand. Let me give you an example. Look at what happened with the coronavirus. We've had dramatic drops in demand at restaurants, yet menu prices have not really dropped off, even though there's a huge demand drop off in there. Another example would be retail stores. It could be for like a Walmart, where you look at some of the shelves and they're completely empty, and you ask yourself, well, why didn't they just raise the price? They could have raised the price to meet up with demand, so they at least have some in supply. But no, they often keep their prices relatively constant, and consumers expect that, by the way. So it's not a complete surprise, but the point is they are sticky. Now back to the story so I can give you some intuition. The long-run aggregate supply curve highlights the idea that the economy now gravitates towards potential GDP as prices and wages fully adjust after short-run shocks in the economy. So what that means is there's various shocks in the economy, and it takes a while for prices to adjust and change, to come back, so that the economy gravitates back towards long-run equilibrium. And let me give you an example with wages. So let's look what happens when there's a recession. We have wages, it's the price of labor, we have demand, we have supply, and under normal conditions we have a equilibrium wage, where supply equals demand. Well, let's say there's a recession, coronavirus hits, for example, demand curve shifts off to the left. Now under normal circumstances, we'd move to a lower wage level. We would move down to this lower wage level. But often those wages don't drop, or it takes a very long time for wages to drop off. They don't happen very quickly. And so notice what happens. Right here, this difference is unemployment. We have supply for labor significantly higher than the demand for labor with the new demand curve that shifts off to the left. And so right here is unemployment. And so you get unemployment. So if you look at what happens during recessionary periods, people tend to get laid off and unemployed, and employers tend to keep wages relatively fixed. So that's a huge discussion in the world of labor economics. So why exactly it happens? There's lots of reasons for it. Because basically the workers that are still working, those workers don't want a reduction in wages. It reduces their standard of living. And so businesses will pay to keep them on board, even during a recession. That concept, by the way, is called efficiency wages, where as a business you may lay off some employees, but you retain others and keep them, even if the business is very slow. You're very hesitant to lose those employees because they're key employees with lots of knowledge and skills. And you don't want to lose them to your competitors eventually. So when the economy picks up, your competitors will end up picking them up. So that's the concept of efficiency wages. So I hope you can appreciate the various terms for potential GDP. And basically, we're going to use the term long-run aggregate supply curve in a later chapter when we look at aggregate supply and aggregate demand and the effect of sticky wages under various scenarios. It occurred to me while I was producing this video that I haven't really explained what a shock is, at least what an economic shock is. You can kind of tell from the term, it's an unexpected, usually a large event that shifts the supply or demand curve right or left. So it can have positive or negative effects. Usually shocks are on the negative side. So it would be a shock, a huge drop in demand suddenly. So you'd have a drop in demand, output would fall, unemployment would increase, prices would tend to fall, but usually they wouldn't fall, as I was telling you, they're sticky, so they tend not to fall enough to bring us back to equilibrium. So there's a delay, and that's the sticky price concept. But you can have supply shocks also, like OPEC suddenly raising oil prices, and then the supply curve for the whole economy shifts up to the left because input prices have just skyrocketed. That would be a negative supply curve shift. And the coronavirus, for example, well, that's a combination now. That's an interesting phenomenon because not only did the demand curve suddenly shift to the left, the supply curve in a lot of cases shifted dramatically to the left also because firms literally shut down. And if firms shut down, then that's a shift to the supply curve basically evaporates for certain firms, and it certainly for the overall economy is shifted to the left. It's an interesting phenomenon. We'll have to see how the dust settles with the coronavirus effects in terms of the economy. But we'll get into a later chapter where we talk about aggregate supply and aggregate demand. We'll get into this concept of shocks a bit more.